Good morning. September 30th, Tuesday, last day of the month, quarter end, month end. I'd expect a lot of the flows relating to that are done, but who knows? Maybe some residual stuff. Dollar selling was widely the theme in FX for the month end rebalancing. Markets this morning, a little bit of risk off, just a tad. Asian markets are down a touch, and Chinese markets are up this morning. But yeah, Kospi, Nikkei, XJO, ASX 200, and stuff like that is down. Chinese markets tend to be a little bit different at times, most times. Currencies, dollar weakest on the day, Aussie the strongest on the day, as the RBA appeared to be more hawkish. We'll touch on that in a second. Pound quite weak this morning, yen the strongest. So a little bit of risk off there. Also oil lower, copper lower, and then gold being the strongest of the precious metals, the other ones having some cyclical characteristics. They're all down. So a little bit of risk off complexion going on. Stocks yesterday, for US stocks, they were relatively strong. We're seeing a broadening in the stock market, which is good because the breadth has been very, very narrow. So yeah, there's no reason to see any real weakness, but definitely some rotations going on. In terms of what's on the calendar today, we have the German CPIs and also the unemployment, which is due in about 45 minutes time. German CPI, and then we have JOLTS today. Lagarde, ECB speakers, no one really cares. Consumer confidence, conference board consumer confidence, which I like to look at, a little bit forward looking. And then the JOLTS, which I hate because it's extremely lagging, but it does give you an idea of quit rates and things like that. So something for the broader trend, see if that broader trend is still intact. Not too much going on in terms of the data calendar. Just CB consumer confidence would be probably the biggest of interest today. Going into the news flow. Now we're still in this shutdown risk looming kind of environment. Trump met with the Democratic leaders. It's suggesting that they weren't any closer after that chat. Vance is saying that it's probably heading for a shutdown. Not too much more to say about that, really. It is fade the news kind of event. Sell the fact. So perhaps sell gold, maybe even buy silver. I don't know, but yeah, would be thinking about stuff like that. Maybe even dollar yen, to take advantage of a nice big pullback if you want to kind of put a feeler in for the dollar. See if we get some good data that causes a bit more bear steepening in the curve and things like that, which I've kind of summarized again. We covered it a lot recently, but summarize it again in case you want to get up to speed and have a refresher in the weekly. More tariffs, same old stuff, and U.S. still targeting Chinese firms, making sure that they're plugging all the holes in terms of Chinese companies being able to get their hands on NVIDIA chips. I would imagine this is mostly what it's about. It's same old stuff, really, right? And then this is supposed to be big political news, but really, I don't really think so. They agreed to a 20-point plan that's supposedly calling for a ceasefire, hostage swap, and also Israeli withdrawal from Gaza and Palestinian type of areas. And then also includes a disarmament of Hamas. It seems ludicrous to think that Hamas is going to accept this.
In the local news, Hamas was already saying that they reject it outright. They're not going to disarm. They don't want to stand down, right? They want to maintain government, right? And then another quote, they're saying they haven't even seen the plan, right? So they don't care what's in it, right? All they need to see is some headlines saying a few points that they have red lines on, and I don't see it going anywhere. Although Qatar has said that they pledged that they will bring Hamas to a deal. So I'm assuming there's probably international pressure behind backdoors on Qatar to get Hamas in line, because everybody supports this, right? Quickly, news around the world came out, international governments were like, yeah, we support it, everybody's behind it, make it happen. This needs to happen, because it's a much broader plan. It's not just about Gaza. Right? Yeah, this is more continuation, the Abraham Accords, right? That's what obviously Trump wants to launch into from this. Ending the war in Gaza would be fantastic. Obviously huge news, and then he wants to catapult that into building the Abraham Accords, further extending them, I presume, because there has been a lot of chatter, and I know BB met with the foreign minister from the United Emirates, and I think also Saudi when he's in the States, and they've said we're not, even during all this, they haven't said that they're going to end normalization. What they did say, though, is that annexing parts of the West Bank would be a red line. But they also said that a while ago about the war, and then they backtracked from that. But the coalition government in Israel is hell-bent on annexing the West Bank. So who knows what that would do to Trump's plan. I can imagine he would put a ton of pressure, Trump would put a ton of pressure on Bibi to not let that happen.
Right. Well,
I
have a theory on that. So the plan is that they want Hamas to basically disarm and even bring in a transitional government. So a complete disentangling of the Hamas regime. Okay,
it has to happen.
But
it has to happen.
So, but he did say that if they don't do this, we'll do something about it, and Israel can do something about it, and they'll have our full backing. So I feel like they're kind of giving themselves a strategic avenue to actually escalate even further. Moving on, BOJ. We had the minutes this morning. Nothing that we didn't really know, although Zach did point out that the odds of a hike has increased for another day. It's been a gradual increase over the past few sessions. Saying the yen edged down, but it's obviously the strongest on the day today. So maybe the initial reaction, maybe it was just a bit of covering or something. October hike. If we do get that, that's another big picture opportunity to think about buying the dip. BOJ events are almost always a fade, but sell the fat type of events for something later, October 30th. So still in a month's time to think about when we get there. RBA, I'd imagine that they were hawkish. I don't think it would have come as a huge surprise. They had this huge CPI beat, if you guys remember. Very strong beat. CPIs rarely beat by a very big margin. And that was, a substantial margin for a CPI report. So they did have weaker employment data, and employment data hasn't been anything great. But in the grand scheme, it is still a very strong labor market. So it's all about inflation. We'll see how that goes. When that sort of narrative starts to fizzle out, maybe that bigger picture Aussie-New Zealand idea will become a little bit more appealing. But now it's kind of lessened in its appeal with the RBA heading in a slightly more hawkish direction. China PMIs this morning, Chinese manufacturing. Tariffs are going to clearly be a drag on Chinese manufacturing, right? A lot of goods are sourced from China, OEM businesses and stuff like that, where you find Chinese manufacturers to make your products, or, you find manufactured products and you brand them and put your own label on them and stuff like that. It's a huge business. Basically, Amazon and a lot of online e-commerce is based on that business model alone. So, it's kind of clear that there's a big drag from tariffs. Now, I wanted to point out this kind of flows and positioning piece that comes out of Bank of America. Some perspectives on systematics And this is a big reason I think could start to change the tide in the kind of upward, well, up only type of momentum that we've seen. We're seeing that, well, for FX, CTAs are very short dollars and they think they could be forced to cover, particularly given that the dollar has rebounded instead of kind of breaking the recent range lower and heading back to those lows to create that double low in DXY. And then that rebound has perhaps kind of neutralized that latest trend following type of signals. So FX positioning is at risk of reversing potentially. And same with ES and US equity futures and Nikkei futures been chased quite strongly. Positioning is elevated, and then some potential paths depending on how the markets trade. So if the markets go up, then CTAs could increase their exposure a little bit further. But if they fall, then, obviously they'd be forced to cover. Yeah, I mean, it's quite obvious that's how they play their game. So, but what I'd add is this vol control bit, which, we've seen this chart before, which I've talked about. And, different models show different things, but they're basically all pointing to the same thing, right? That positioning is kind of a little bit more elevated. And if you look at the 5% one, that means that if portfolio volatility starts to get to 5% or above, they have to reduce their holdings to ensure that their portfolio volatility doesn't go above that 5% threshold. And the same with 10% to make sure their portfolio volatility doesn't exceed what's mandated by their fund mandates, right? That they have their own rules for these funds. So if we have a little bit of volatility and CTAs, given their elevated positioning, a little bit of volatility forces the CTAs to start covering their longs, then that begets a little bit more volatility. And then because vol control funds, their allocations and their exposures are at elevated levels, then they start to maybe unwind. So that begets more volatility too. I'm kind of concerned that, it could trigger a little bit of an unwind in systematics, which leads to this kind of mechanical type of selling in the market, right? So very, very interesting kind of setup from a systematics point of view. And of course, options is a very important perspective on the market these days. So BofA notes that SPX gamma, it's now modestly long. And SPX gamma is basically the market maker's exposure. It's been quite long in terms of the extremes on this chart. And when it's quite long, when the positioning is quite stretched, it means that SPX dealers who are short options, who've been selling the options, have a greater degree of exposure. And so when the market starts to move higher, for example, then their exposures are at risk. And so they have to do what's called delta hedging, which basically involves them going out and buying the primary asset or the underlying asset or ES futures or something like that, which kind of feeds back into the market and that drives more buying and so on. But also has this effect of suppressing volatility. When the market gamma is stretched, it means there's much more hedging going on. And because of that hedging activity, it means that the volatility is less likely to kind of expand because of that hedging, right? For example, if these gamma levels were lower, like here, for example, there is less need to hedge. Because there's less hedging, volatility is allowed to expand and price can swing a lot more because there is no hedging to offset this increase in volatility. So I guess the main takeaway here is that when we've had high dealer gamma, you tend to see high delta hedging. You tend to see price volatility being suppressed. You might have heard things like options people talk about spinning, price pinning, vol dampening. That's the kind of words the buzzwords that you get when gamma is high. But now that it's become more neutral, it means that there's less hedging activity, and it means that vol is less suppressed because it's not being hedged. And so now you see an unpinning. You don't have the dampening effects, and you tend to see price able to move a little bit more. So overall, I think this is a really interesting setup that we're getting in equities right now. You have the CTAs, the vol control, and this dynamic here with the SPX options gamma becoming more neutral. All those three factors could interplay between each other and beget more volatility as, and so on. So what could do that? It's this. We've had a period where the Fed has cut as economic data is getting better, particularly on the consumption side, right? With the retail sales control group pointing to strong consumption report. And sure enough, we got a consumption beat, and the PCE incomes also looked strong. Claims reversed. The unadjusted claims is right at the low end, right? So it implies that unemployment is still very, very low, even though that unemployment figure has been kind of slowly rising, which, is consistent with continuing claims trend. But, it still suggests that there's no real imminent trouble in the labor market. And then we're seeing a little bit of bear flattening follow that bear steepening, and that's in response to economic data being still very, very good and the Fed cutting. And so the market probably doesn't believe in the fact that the Fed is going to cut all that much next year, right? So we had like 80 basis points of cuts priced in for 2026 about a month and a half ago, and now it's we're leaning closer to 2 cuts than we are 3. So that relates back to this kind of dynamic of this bear flattening. That's kind of, it all ties in together. Obviously, there were still some growth concerns, and so we saw some bull steepening as, the rhetoric about a more dovish Fed increased, and some growth concerns, perhaps because of, claims and a few other bits of data. Also, NFP was quite weak as well, but then we got better data. So this week is quite pivotal in terms of how the macro could change. Will it reverse the kind of growth concerns that we had from the August payrolls report? Who knows? But the more we get good data, the more we'll stay in the bear regime, and the 10-year is at risk of going above 4.2%, which is, I think, it starts to be the pain point for equities. It hasn't so much lately because it's coming off very, very low levels, and equity markets don't really care about, this sort of move, but they will once we start getting, making a much bigger move above 4.2. So for that, we'll need a very strong NFP report, although I don't know if we'll get one. And even if it's weak, I don't know how weak that is. We might not even get one because of the shutdown, right? Which would be fun. But yeah, that's the main thing to think about. And then interestingly, we're seeing the 10-year rates regime go into a tightening response, right? And that's basically a response to this. It's all interrelated, right? What happens is, if you want a quick refresher, go into my weekly, down to the bottom at the end somewhere. You tend to see growth and inflation expectations go up, so we get this bear steepening. You then tend to see policy expectations tighten as a result of that, and so we get a bear flattening. And what happens is the 10-year rates, which is a reflection of longer-term growth and inflation, as well as longer-term financial conditions, right? Because you have the inflation component, and then you have the real rate component, right? The difference being the inflation break-evens that they call it. And this is what this regime is, right? The tightening is where you see the inflation component selling off, and you see real rates go higher, right? So break-evens are falling and real rates go higher. Real rates going higher, and then the break-evens falling, meaning the longer-term growth and inflation expectations are falling. That is what dictates this tightening regime that we see here. And normally, it's not good for risk assets in general. For example, the DXY, for instance, normally when you see real rates rise, you do tend to see the DXY rally or the dollar rally. Maybe dollar yen is a better example, because DXY this year has been, it's had a mind of its own at the beginning of the year, right? It's diverged from 2-year rate spreads. We've never seen that kind of divergence in a very, very long time. And then more recently, it's catched down the rate spreads to the dollar. So right now, the dollar relative to 2-year rate spreads are looking much more fair. And perhaps we'll see a little bit more ability for the dollar to... Okay, thank you. Thanks for that. So yeah, and dollar yen, we can see that, right? We go into the tightening regime, and then the dollar starts to pick up. Not so much here, but definitely more prolonged periods of tightening. We do tend to see the dollar pick up. Put it on a longer term basis. So red here, and dollar picks up. Yeah, stuff like that. Okay, so interestingly, we're seeing that dynamic now. We're seeing real rates starting to become more impactful in these rates moves, right? Even though the 10-year is looking a little bit sluggish, real rates are starting to catch up. And that's quite significant. And the 10-year has been falling because of, longer-term growth and inflation expectations being affected by this dynamic. Front-end policy expectations are getting a little bit more hawkish. And so that is what's affecting long-term growth and inflation component of nominal rates, right? For nominal rates, you have that growth and inflation expectations on top, and the base component is real rates. You take away those growth and inflation expectations, and you're left with real rates. And that's what's happening here. We're seeing longer-term growth inflation expectations recede as a result of a more hawkish direction in the front-end rates, and therefore we entered this tightening regime. And the more we get this, the more risk assets tend to falter. This is their worst. You backtest this going, as far as I've concerned, I've done it as far as the year 2001. Sometime around then, maybe even 2003, just to avoid all the shenanigans that happened around 2000 and 2001. If you look at SPX, in these red regimes, or especially when it goes red, stocks do not perform all that great. We had a bit more red here. Now, this does have a lag. It does kind of have a 21 look back, so there is a little bit of smoothing and a lag to this. But if there was a bit of tightening here, you can imagine it sort of starting around here. In fact, we can see a little bit of red here. You can see that stock markets didn't perform so well from that point on. But generally, it's not a great time, or it's very difficult to argue for a stock market rally. So a little bit of red here. We had a nice long period here, and we went nowhere, right? Markets needed the suspension, where you see both break-evens and real rates go up. That's when economic conditions are really looking like it's going to improve. The buying, to contrast, is where economic expectations are going up. Also, real rates are falling. And so that's why this is a buying phase. So that's the interplay that we're looking at, and what is at the top of mind for this week, with this week's data being able to really have an influence on what kind of regime and the kind of flavor of the macro in the coming weeks.